Welcome to Best 1031 Online, where you will get expert insights into all aspects of tax-deferred 1031 exchange from some of the nation's most well-known commercial real estate professionals, as well as CPAs, accommodators, wealth managers, and others. Here's your host, 1031 Broker James.
Let me tell you something. If you're a practicing commercial real estate broker trying to keep up in today's market, you cannot do it all yourself. I couldn't do what I do without my virtual assistant from CRE Task Wizard. Their VAs are trained specifically for commercial real estate administrative work, which frees me up to focus on revenue-producing activities. If you want your time back and your sanity back, go to CRETaskWizard.com. Tell them 1031 Broker James sent you, and they'll waive your onboarding fee. CRE Task Wizard. Buy your time back.
Hello, and welcome to this episode of QI Corner. With me, my host, Greg Burns of IPX 1031. Greg, how are you?
I'm doing good. How you doing?
I'm great. Today, we are going to talk about partnership issues that come up with a partnership that owns a certain property or properties and they want to exchange or don't want to exchange. That's usually what comes up when an exchange is considered, or can the partnership exchange? And in this particular episode, we're going to really focus on the limited family partnerships. I come across this on a pretty regular basis, including I have a live case right now where it's a limited family partnership. There's 3 partnership entities within the limited family. 2 of them belong to 2 brothers, one each. And then the third partnership is a brother and sister who are cousins to the brothers. And so while they all want to exchange, the issue is that all of these people are in their 80s and they are going to want to unwind the properties or property they exchange into, and what might be the smartest way to do that. But before we get into that, let's talk about those limited family partnerships where there's 3, 1 wants to exchange and 2 do not.
Yeah, so I think that so California and New York are really the only 2 states that kind of take issue with this drop and swap, transaction. The IRS doesn't really seem to have much interest in it, and New York actually just got beat on a case about 2 months ago on drop and swaps. California has competing cases. They have a case where the taxpayer prevailed, then they have a case where the franchise tax board prevailed. So in California, it's kind of split right now. Any other states, there's no issue with drop and swaps. Most tax advisors would tell you, hey, if you're going to do, a drop and swap, you're going to get out of the partnership and into like a tenant in common structure, try to do it before the property is marketed for sale. But in California, the California Franchise Tax Board, they take a position on it, which is, hey, the family limited partnership held the property for investment, but these individual tenant in common owners held the property primarily for sale. And properties that are held primarily for sale don't qualify under Section 1031, so you don't have a valid exchange. So there's multiple ways to kind of get around it. Obviously, you can deed out of the partnership into a tenant in common structure, hold the asset for 12 months or more, and then kind of avoid that argument. The other way to do it in a situation where maybe 1 wants to exchange, 2 want to cash out, what I might do in that situation is I might take the 2 that want to cash out, make them, tenants in common, keep the member that wants to exchange in the family partnership. You're going to have to add a member or ask one of those 2 members if they're willing to stay in for, let's say, 1%. And then when the property sells, the 2 tenant in common owners are going to get cashed out. And then the member that wants to trade is going to stay in the family limited partnership and then move forward with an exchange. So, and the reason you structure it that way is so that the person that wants to exchange keeps the tax ID number of the family limited partnership. Attorneys also, structure this thing in a partnership installment sale sometimes, where they structure it a little bit differently. Some of the tax attorneys that I work with, they like to do this partnership installment sale where they basically set up installment sale payments where, these two, owners that want to get cashed out, they get cashed out for 95%. They keep 5% in as an installment note and then get paid out in a year. So we do structure those types of exchanges as well. They are kind of more expensive because we're required to hold on to a note for 12 months. But that's another structure that works. You could also, and you kind of mentioned it earlier when we were talking a couple weeks ago, you could, if you had multiple clients that wanted to trade in a partnership, you could keep them in the partnership, have the partnership buy multiple assets, and then distribute those assets to the individual partners, a year or two down the road after they own it.
Yes, that's so far with the family I talked about at the top that's what we're looking at, is that the partnership as a whole will exchange into two properties. They'll buy the properties, and then a year, 2 years later, because there's really no rush, but probably a year later, the four of them will drop into tenants in common. So the two brothers will take one property, and the sister and brother will take their property. And how they'll basically separate from each other is they do a quick claim. So the two brothers will quick claim that property to them, and the other ones will quick claim that property to the other side. And hopefully that won't trigger, I think a quick claim, it's not going to trigger a new tax assessment, right? And I'm sure that has everything to do with what state it's in.
It can. Yeah, I mean, it can. So that's something that kind of can take into consideration. But typically they've only owned it for a year, so it's not going to really adversely affect them. Typically, they do a partnership allocation where they allocate the property to those partners and then do a quick claim deed to transfer it.
Right. So you mentioned something about, in California, obviously we are both in California, and our number one nemesis is the FTB. I mean, no one hates the 1031 exchange more than the California Franchise Tax Board. At least that's been my experience. And a couple of cases that I've read that where the FTB, I don't think the FTB loses very often, but they fight tooth and nail, man. They want to keep the California tax dollars right here in California. But you had mentioned something. So this happened to me this summer where a son whose mom was in a partnership of a property. There was multiple members, and all the members wanted to exchange, but the mother did not want to exchange. She just wanted to cash out. Her position was very small. It wasn't like it was going to be, the tax implication was such that it's better that we just cash out versus exchanging with the partnership. And that was my suggestion to them is, see if, I can't remember if they had a closing date, but I told them, I was like, see if they'll allow your mom to drop into a tenant in common situation, and maybe make that work. But how important is that timing?
When someone just like an individual member wants to cash out, typically they record. So the concern always with these bigger partnerships sometimes is like, hey, we don't want to tick this person onto title. And then what if the sale blows up? Now we've got this individual tenant in common on title. So typically they record the deeds concurrently, where they'll record a deed transferring their interest to this tenant in common owner, then immediately, 1 minute later, record the deed to the new buyer. So it does take some work from your perspective because you're going to also have another seller. So you have to amend the contract a lot of times to add that person to the contract. But ultimately it's pretty straightforward. I mean, they're pretty easy to do. The key is, what you're trying to avoid is, potential drop and swap issues where the FTB is coming after you. Now I do have clients that do drop and swaps. I probably see 3 or 4 people a month do drop and swaps where they just kind of throw caution to the wind and say, well, my chances of getting audited are really low, and I'm going to try it anyway. And we don't see a ton of those people getting audited, but it goes back to advanced planning. I mean, it goes back to like when you have that conversation with them, before the property is even considered for sale. Hey, I see that you're in this limited partnership, or I see you're in this LLC. Are there multiple members? Do they all want to do an exchange? And if they don't, who wants to exchange? Who doesn't want to exchange? Are there people that want to exchange individually? So that you can kind of put a plan together so that, you can kind of accomplish your goal.
Right. And there's that word again that we use pretty much in every episode, the plan.
Yeah.
It's all about, you have to sit down and plan. Obviously, the more moving parts you have, the longer you should plan is really how that goes, especially if you're in an entity with multiple partners. Not everybody wants to exchange, but the majority of partners do, or the other way around. Like I've got another situation where 2 brothers and a sister are in a partnership, and the sister isn't really have the capacity to be engaged with it. And so she's pretty much, I think her brother, the older brother, has power of attorney for her. And so those 2 aren't going to exchange. But the younger brother, he's like, I absolutely want to exchange. And so they've already, fortunately, that delay got sailed. The sale got postponed. It is going to sell, but it's going to sell differently than they thought the tenants were going to buy it. And no, the tenants are going to move out. And so now it's on the market for sale. But prior to that happening about a year ago, the younger brother said, hey, you guys need to make me a tenant in common so that when you guys when you guys sell this, I'm going to be able to go and do my own exchange. So,
yeah. I've seen a lot of clients this year that are not on the market, but that, people call me all the time and they're like apologizing that, hey, we're not in a transaction right now. And I'm like, calling me right now is probably the best thing that you could do, right? It's like, let's talk about what you're trying to accomplish. And I had a great conversation with a title guy that I work with that is going to make some moves. And although he has been to a ton of my classes, and I kind of scolded him for not listening, he was like, oh, well, I'm selling this deal for $800,000. I just got to go reinvest the $400,000 of equity I have. I'm like, no, you do not. You have to buy something for 800 or greater. He was like, oh, I just thought I had to reinvest my equity. And I'm like, no, you need to listen to me more when I do my classes. So
it's unbelievable how often I just had that conversation this week. Same thing. People said, yeah, there's going to be this much left over with the accommodator when we're done. And I said, was there any debt in the property? And they're like, yeah, but, it's nominal amount. We're not going to worry about it. And I'm like, whoa, wait a minute. Yeah. So, and I blame the internet on that. People go on there and unfortunately, it's a lot of real estate agents or these,
there's just bad
investors that say, look, all you have to do is reinvest your profit. No, that's not how it goes.
Yeah, I mean, I had a client that not that long ago, like 6 months ago, she had a client that she helped buy a property, and she talked to me about doing a reverse exchange, and I kind of explained the process to her. And then for whatever reason, she did research on the internet, and she called me up like a week after it closed and said, hey, we're ready to set up the reverse exchange. And I'm like, okay, well, when are you closing on the purchase? They're like, we already closed. I'm like, you can't do a reverse. I'm like, you have to get it set up before that closes. And she's like, well, she sent me literally like a screenshot of the internet where it said, oh, you can do a reverse exchange after you close. I was like, oh boy. So, so it's always important just to, call people that are involved in the business that can, give you the right answers.
Right. And for those of you watching, that's why you should like and subscribe to Best 1031 Online. Greg and I do 2 of these QI corners every month. You're more than welcome to reach out to either of us, but definitely make comments if you watch this and make a comment to what we talk about.
If there's something they want to know about that we haven't covered yet, make a comment on there and let us know what you want us to cover.
Great idea. That's an excellent idea. All right, Greg, thank you again. Appreciate it. We'll see you in a couple weeks. And for all of you out there, thanks for joining us on QI Corner, and we'll see you next time.